My name is Susan Huffard, and I'm an attorney in the Greenwich office of Cummings Lockwood. And my presentation today is 10 points you should consider when administering an inter vivos irrevocable gift trust. So this would include an insurance trust or any type of estate reduction trust or a split interest type of trust, such as a GRAT. I'm going to present these topics in a little bit of a chronological order of the points that you would want to consider from the time the trust is established through roughly the first year of the trust, just to make sure it gets up and running correctly. I'm going to touch on a lot of different topics, but the goal here is really just to provide you with a checklist of the points that you should be considering when a client of yours establishes a gift trust to make sure it's being administered correctly. So the first point is that when you do establish an irrevocable gift trust, you do need to obtain a tax ID number for the trust, since it is a separate income tax entity. Even if it's going to be functioning as a grantor trust, and all income is going to be reported on the grantor's 1040 and not on an income tax return filed by the trust still should have its own tax ID number to make sure you identify it as a separate entity. The next thing to consider is how are you funding the trust? In order to fund the trust, the grantor needs to retitle assets from the grantor's name into the name of the trust. The trustee then becomes the owner of legal title to the trust property. When retitling assets, the important thing to make sure of is that the grantor and the trustee follow whatever formalities are required to transfer the asset to ensure that the grantor makes a completed gift. A completed gift to the trust should remove the asset from the grantor's estate, and that is the goal of the gift trust. A couple of things to bear in mind here is that if the grantor's spouse is a beneficiary of the trust, you have to make sure that the assets to be gifted to the trust are held in the grantor's sole name and are not jointly owned with the spouse. If the assets that are gifted are jointly owned with the spouse, then half the gift is made by the spouse, and that would cause all sorts of estate inclusion issues for the spouse, which you do not want to. Also, with respect to life insurance, as probably all of you know, if a grantor dies within 3 years of transferring a life insurance policy to a trust, the policy will be included as an asset of the grantor's estate, even though the gift to the trust was completed. And that 3-year period doesn't begin to run until the insurance company actually records the change of ownership in its records. So it's important for the trustee to receive back confirmation from the insurance company that the transfer has been completed and recorded in the insurance company's records. So the next point to consider is how do you properly value the gift? The value of the gift is the fair market value of the property that's transferred on the date of the gift. Remember that this is the date of the transfer, which is not necessarily always the same date that the trust is signed and established. For publicly traded securities, it's relatively straightforward. It's the average of the high and low trading prices for the securities on the date of the transfer. For real estate or other closely held entities that aren't publicly traded, the valuation should be done by a qualified independent appraiser. If discounts are going to be taken, you should also obtain an appraisal that will substantiate the discount. A point to note with valuations, even though you value the asset as of the date of the transfer for gift tax purposes, that value does not establish a new tax cost basis for the assets for income tax purposes. So the gifted assets in the trust retain the grantor's tax cost basis. And the grantor should provide that information to the trustee, as the trustee is going to need that going forward to prepare the trust income tax returns. The next point you want to consider is filing the gift tax return. A Connecticut resident grantor must file both a Connecticut and a federal gift tax return, and both are due on April 15th of the year following the year of the gift. A couple of issues to note with respect to reporting gifts. The first involves gift splitting. Gift splitting is an election that can be made on a gift tax return where the grantor's spouse consents to have one half of the grantor's gifts deemed to have been made by the spouse, even though they were made entirely by the grantor. And this essentially allows spouses to combine the use of their exemptions. But this can get tricky if the gift is to a trust of which the grantor's spouse is also a beneficiary. In that case, the gift can only be split to the extent that you can determine the value of the portion of the gift that's actually being made to the non-spouse beneficiaries. This is not a straightforward analysis, so just make sure that if your grantor's spouse is a beneficiary and the grantor is looking to split gifts in that year, that this point gets a proper review. The gift may be eligible to be split depending on the terms of the trust, but often it is not. You should also be aware of the statute of limitations for the IRS to audit a gift reported on a return. It's 3 years if the gift is adequately disclosed on a timely filed return. That statute of limitations will extend to 6 years if you've omitted information. And of course, if you don't report the gift at all and don't file a return, the statute never runs. So you want to provide as much information as you can on the gift tax return, adequately disclosing the gift in order to satisfy that standard and get the 3-year statute of limitations running. So at this point in time, you also should be considering whether or not to allocate GST exemption to gifts that you've made to the trust, as that is also something that you do on a gift tax return. A couple of things to keep in mind with GST exemption allocations. The IRS has automatic deemed allocation rules, which will automatically allocate GST exemption to any gift made to what the IRS defines as a, quote, GST trust, whether or not you file a return. And the IRS's definition of a GST trust is often going to include a trust to which you might not want to have exemption allocated. It's a rather broad definition. So if that's the case, it's important that you opt out of the automatic allocation rules on the gift tax return. Another item to note here is with split interest trusts, such as a GRAT, you actually can't allocate GST exemption to a split interest trust until the grantor's retained interest term expires. So for instance, if you have a GRAT with a 3-year term, you can't allocate GST exemption to the remainder interest until the end of the 3-year term. And to do that, you need to file another gift tax return at that time to make the allocation. What about trusts and annual exclusion gifts? A gift to a discretionary gift trust will only qualify as an annual exclusion gift if the grantor has given the beneficiaries the right to withdraw a portion of the gifted assets up to the annual exclusion amount. And these withdrawal rights are commonly known as Crummey rights or Crummey powers after the court case that approved their use. A couple of points you need to be mindful of regarding annual exclusions and trusts. You need to be careful to coordinate for your client any withdrawal right gifts with any other annual exclusion gifts the grantor is making that year, including withdrawal rights in other trusts, gifts to UGMA accounts, gifts to college accounts. All these gifts count toward the same total annual exclusion per beneficiary per year. So the extent you're using them in one place, you cannot use them in another. Also important to note here is that gifts to a discretionary trust that qualify for the annual exclusion from gift tax don't qualify for the annual exclusion from GST tax. So you still need to determine whether or not you want to allocate GST exemption to the transfer, or if you want to opt out of allocation of GST, even though it's not a taxable gift for gift tax purposes. And if your trust has Crummey withdrawal rights, you need to be sending Crummey notices. So the trustee is responsible for sending a notice to each beneficiary whenever a transfer is made to the trust to notify the beneficiary of his right to withdraw a portion of the gifted assets. It's important to remember that if the right to withdraw the assets is not exercised, it lapses. And usually the lapse is limited to the greater of $5,000 or 5% of the value of the trust assets. So if the amount of the withdrawal right exceeds the lapse amount, the excess withdrawal right normally carries over into the following year. So for instance, if a beneficiary has a right to withdraw $10,000 and the right only lapses to the extent of $5,000, the right to withdraw that remaining $5,000 will carry over to the next year and will stay exercisable until that year's lapse takes effect. And these carryover rights are referred to as hanging Crummey powers. And it's important for the trustee to be keeping track of all of these, withdrawal gifts and withdrawal rights and hanging Crummey powers every year. Just a note, if a spouse is a beneficiary, spouses are usually limited to a $5,000 withdrawal right and a $5,000 lapse in order to avoid giving the spouse a hanging Crummey power. If the spouse were to die with an outstanding withdrawal right, it would be included as an asset of the spouse's estate, and you want to avoid that. So you should really be careful to review how the withdrawal rights in the trust operate and make sure they're being calculated correctly each year. The next administrative point to consider would be a trust income tax return. The trustee has to file an income tax return for the trust in any year the trust's gross income exceeds $600. Any income earned in a trust that's not distributed out to a beneficiary is taxable to the trust. Trust income tax rates reach the highest tax bracket at about $12,000 of income. So there's often opportunity for income tax planning at the end of the year by making distributions to lower income bracket beneficiaries, and that should be reviewed annually at the end of the year. If the trust is a grantor trust, all income is instead reported on the grantor's 1040 and is not taxed to the trust. Grantor trust rules are complex, and there are several trust provisions or different trustee arrangements that could trigger grantor trust status. So it's important to carefully review the trust agreement and also confer with the drafting attorney to determine whether grantor trust is intended or if it's desired. Sometimes you can turn it off if it's something the grantor decides they don't want to be having anymore. Also bear in mind, if a trust owns life insurance on the grantor's life, it will be a grantor trust until the grantor dies. So for that reason, a grantor should always be wary of transferring income-producing assets to a trust in excess of those that are needed to pay premiums if the grantor doesn't want to be liable for the income tax on those trusts. Okay, so those first 8 points covered a lot of ground, but they're a good checklist of the administrative points that you want to consider during the first year of the trust to make sure it's been set up correctly, it's been funded correctly, your transfers have been completed, that you've complied with all the relevant gift tax rules, GST tax rules, and income tax rules. These final 2 points are more related to the ongoing administration of the trust. The first is the fiduciary duties of trustees. Laura explained earlier what a cumbersome job it can be to act as a trustee. Not only is it a big job, but you're held to a higher standard. You're subject to fiduciary duties as a trustee, a fiduciary duty standard of review. So the bottom line with that is that the trustee really needs to make sure to schedule periodic reviews of investment performance, investment decisions made in relation to the goals of the trust, the beneficiary's needs and circumstances, and keep good records related to all decision making so the trustee can defend his actions as made within the parameters of these fiduciary duties. And finally, trust accountings and releases from liability. The trustee should periodically seek a release from liability for his or her term as trustee. This can be in the form of a judicial accounting that you would file in a court, or it can be a more informal type of accounting that you would circulate to the beneficiaries and ask them to sign a release agreement approving the trustee's actions. If there are no real issues with the trust administration or the investments that you've been making, a non-formal accounting is generally less expensive and less time-consuming. But if there are any concerns with the trust administration or if with a particular beneficiary, it might be better for a trustee to seek a judicial release.